Imagine making an investment that could either set the foundation for immense wealth or lead to a painful loss. You have limited funds and a big decision to make. This was Warren Buffett's reality. Known today as the Oracle of Omaha, Buffett built his fortune by focusing on long-term investments, especially in undervalued companies. But what would you have done if you were in his shoes, investing at such a young age with so much at stake? From an early age, Warren Buffett showed an uncanny talent for numbers and a love for investing. At just 11 years old, he made his first investment. But it was in his early 20s, after studying under Benjamin Graham, the father of value investing, that he began to truly refine his approach. Graham taught Buffett the importance of looking for undervalued companies, those with solid fundamentals but low stock prices. This became Buffett's guiding principle and the foundation of his investment philosophy. One of his first big tests came when he invested a significant portion of his early capital into a textile company called Berkshire Hathaway. The company was struggling, and most investors would have considered it a poor choice. But Buffett saw value in its assets and believed he could turn it around. Little did he know, this investment would lead him down a difficult path and ultimately shape his approach to investing forever. Now imagine yourself in Buffett's position. You put a large amount of your capital into a company that others have written off. You have two choices, but both come with considerable risk. Here's the question. So, what would you do? Option 1. Sell your shares now to cut your losses, learn from the experience, and move on to safer investments. Option 2. Stick with your investment, committing to Berkshire's turnaround in the hope that your strategy and patience will eventually pay off, knowing you could lose it all. Both choices come with risks. Selling now could protect you financially, but at the cost of missing out on any future potential. Holding on means betting everything on your confidence and patience with no guarantee of success. Warren Buffett chose the second path. He committed to Berkshire Hathaway. Over the years, he made several attempts to revitalize the struggling textile business. He poured time, effort, and capital into revamping its operations. However, the textile industry was on a steep decline, and despite his efforts, it became clear that no amount of capital or management changes would reverse its fate. Buffett realized he had made an error in judgment about the potential of Berkshire's core business. But here's the key to Buffett's decision. Instead of giving up on Berkshire Hathaway altogether, he saw a new opportunity to repurpose it. Buffett transformed Berkshire from a failing textile company into a holding company, using it to acquire shares in other more profitable businesses. He took Berkshire's capital and reinvested it in insurance companies, manufacturing and retail businesses, industries that offered higher returns and more stable prospects. This transition wasn't immediate. For years, Berkshire remained a relatively small company, and many in the investment world doubted Buffett's unconventional approach. Yet, his patience and disciplined strategy eventually paid off. He purchased shares in high-quality businesses like Coca-Cola, American Express, and Geico, gradually turning Berkshire Hathaway into a diversified giant. Think about this. If Buffett had stuck solely to the textile industry, he might have lost his initial investment entirely. But by adapting his strategy and using Berkshire as an investment vehicle, he turned a poor investment into a launching pad for one of the most successful companies in history. His willingness to reassess his approach was crucial. He didn't let pride or stubbornness dictate his choices. Instead, he allowed the facts to guide him, even if that meant drastically changing his original plan. Buffett's story here teaches a critical financial lesson. Sometimes an investment isn't about a single business or product. It's about the framework you build around it. Buffett's decision to repurpose Berkshire Hathaway showed that value isn't always obvious. Sometimes you have to redefine it. So was it the right decision? For Warren Buffett, absolutely. By committing to his investment but adapting his strategy, he turned a declining company into a multi-billion-dollar empire. His experience with Berkshire Hathaway taught him patience, flexibility, and the importance of looking beyond short-term failures to find long-term success. But what would you have done in his position? Would you have held on and repurposed the investment? Or would you have taken the safe route and sold your shares? This story shows us that in finance, sometimes the value of an investment lies not in its immediate returns, but in how adaptable you can be when things don't go as planned. The question is, are you willing to stick it out and adapt to new opportunities, or do you prefer the safety of a guaranteed return? Leave your thoughts in the comments and subscribe for more stories on financial decisions that will make you think.